You're looking to cut through the noise, right? Get a clear picture of what's happening in the markets without, feeling like you need a PhD in finance.
Uh-huh.
Well, that's exactly what we're up to today. We're diving deep into a really significant event, the stock market downturn of April 3rd, 2025.
Absolutely. We've been looking closely at an article that poses, well, a crucial question in light of this. Stock market crash of April 3, 2025. An investment opportunity or a warning sign?
Right.
Our goal really is to extract the essential insights for you, helping you understand the gravity of what happened and what it might mean without getting lost in endless data.
Okay, April 3rd, 2025. This article paints it as a day the financial history books will remember, and the numbers, well, they certainly back that up.
They really do.
The Dow Jones took a massive hit, dropping 1,700 points. The article notes that makes it the fifth largest single-day fall in its history.
Wow. Fifth largest.
Then the tech-heavy Nasdaq saw about a 6% decline, the S&P 500 around 5%, and the smaller companies in the Russell 2000 really got hammered, with some estimates putting their drop between 6% and a staggering 12%.
Yeah, that Russell 2000 range, 6 to 12%, that's huge volatility for small caps.
Definitely.
And what's fascinating here, I think, is just how widespread the selling pressure was. It wasn't like isolated to just one area of the market.
Right, not just tech or something.
Exactly. The article gives some really telling examples of individual stocks. RH, for instance, which, focuses on high-end home furnishings, plummeted by an incredible 40% in just one day.
40%, goodness.
Yeah. And Stanley Black & Decker, a name many are familiar with, saw a 16% fall. And even, bellwether industrial companies like Caterpillar and United Rentals weren't spared, dropping 8.6% and 8.5% respectively. This really underscores that this was a broad market event.
Right. And to really get a sense of the market's anxiety that day, the article highlights a major jump in the VIX. Now, for those who aren't tracking it constantly, the VIX is often called the market fear index. It shot up to 30. What does a VIX reading of 30 really tell us about the market's mood?
Well, think of the VIX like a gauge of how much turbulence investors are expecting in the near future. A reading of 30 suggests, well, a pretty bumpy ride ahead.
Okay.
It signifies a heightened level of uncertainty and the expectation of continued significant price swings in the market. Lots of volatility expected.
Okay, so a lot of red on the screen and like a palpable sense of fear. But the article then introduces a different perspective, this idea that this sharp drop might actually be a chance for some investors to buy. It almost sounds contradictory, doesn't it?
It does on the surface, yeah. But the article shares a compelling story of an investor who, on that very day of the big sell-off, put a substantial $143,000 into the market.
Wow.
Their largest single-day investment ever. Talk about going against the grain.
Exactly. What's the thinking behind a move like that? I mean, when everyone else is selling.
Well, the article connects this to historical market behavior. The analysis suggests that when the VIX spikes above that 30 level, it has often marked an attractive point to start buying.
Interesting.
The rationale is that the widespread panic can push the prices of even fundamentally strong companies down to levels that don't really reflect their long-term value. Essentially the classic idea of buying when others are selling fearfully.
Buying the dip, but on a big scale.
Okay.
Interesting. So while some are panicking, others are seeing potential opportunity. But the article also spends a good amount of time on the growing worries about a possible recession.
Right, the R word.
Apparently, Goldman Sachs, a major player in the financial forecasting game, has revised its outlook and now estimates a pretty high 60% chance of a recession.
Yeah, 60%. That's definitely a number that gets your attention. And if we link this to some of the stock movements we saw, it starts to paint a clearer picture of those underlying economic concerns.
Oh,
For example, homebuilder stocks like Toll Brothers fell by 8%. That sector tends to be very sensitive to expectations about economic growth and interest rates.
right. Housing is always a big one.
Exactly. Their decline likely reflects the market anticipating a slowdown in housing demand if a recession actually hits. People get nervous about big purchases.
Makes sense. And it wasn't just the stock market feeling the chill, was it? The price of crude oil also took a significant tumble, dropping by over 7%.
Yeah, over 7%.
The article points out how this adds fuel to the recession fears because typically strong economic activity goes hand in hand with higher demand for energy, including oil.
Precisely. A sharp drop like that suggests traders are betting on lower demand down the road, which usually means a slower economy.
And there was something about OPEC, too.
Yeah, what's also noteworthy is what the article mentions about OPEC. They are apparently considering increasing their oil production.
Increasing. When prices are falling.
Well, that's the interesting dynamic. If that were to happen, it could put even further downward pressure on oil prices, potentially amplifying those concerns about a weakening global economy. It introduces this potential scenario where supply could actually worsen the price decline driven by demand fears. Kind of a double whammy.
Now, here's something that really stood out to me in the article. The unusual behavior of what are normally seen as safe haven investments.
Ah, yes, the safe havens.
When markets get rocky, you often see investors flock to things like gold and silver for safety, right?
Yes.
But according to this article, even those assets retreated on April 3rd.
Yes, that's a really key point and highlights, I think, the depth of the market unease. The article specifically mentions an 8% drop in the price of silver.
8% for silver, that's a lot.
It is quite a significant move for traditional safe harbor. It suggests that on that particular day, investors had very few places they felt truly safe parking their money. It really underscores the pervasive nature of the market jitters when even the usual hedges are selling off. Kind of a nowhere to hide feeling, maybe.
But then the article shifts gears a bit, focusing on the perspective of someone investing for the long haul.
Right, long-term view.
The point is made that historically, these kinds of market corrections, as unsettling as they can be in the short term, have generally been followed by market recoveries.
Exactly. The emphasis here is on looking beyond the immediate volatility and maintaining a long-term focus. The article stresses the importance of something that's often easier said than done.
Discipline.
Discipline, yeah.
Hard when things look scary.
Very hard. But it means sticking to your investment strategy and having the ability to identify companies with strong underlying businesses, good fundamentals, that might become temporarily undervalued during these market dips.
So finding the diamonds in the rough.
Essentially, yes. These can be the opportunities that drive long-term growth in your portfolio.
The article also flags one specific economic indicator that it says investors should be paying close attention to, the 10-year Treasury bond yield. Why is that particular yield so significant?
The 10-year, well, think of the 10-year Treasury yield as a benchmark interest rate for the entire economy. It influences the cost of borrowing for, well, everything from mortgages to corporate bonds.
Okay, so it affects a lot.
A huge amount.
Yeah.
So its movement can give you insights into the market's expectations for future economic growth and inflation. For example, if the yield is falling, it might suggest concerns about slower economic growth on the horizon.
And if it's rising?
Conversely, a rising yield could indicate expectations of stronger growth or potentially higher inflation. The article rightly points out that it plays a crucial role in long-term financial planning and decision-making for both businesses and individuals. It's a really key barometer.
Got it. So as you're taking all this in, what's the core message for you, the listener, from this deep dive into the market events of April 3rd, 2025?
I think the crucial thing is to stay informed, but try to avoid getting caught up in any emotional reactions to short-term market swings. This event on April 3rd clearly presented both potential risks and possible opportunities.
Right, that dual nature.
Exactly. The significant market declines, the increased volatility reflected in the VIX, and the growing concerns about a recession are all important factors to acknowledge. However, looking back at market history, we often see that these kinds of corrections can create openings for investors with a long-term perspective.
The disciplined ones.
The disciplined ones, yes, who can identify fundamentally sound companies whose stock prices have been temporarily depressed. And the unusual behavior of traditional safe havens also reminds us that market dynamics can be complex and not always predictable in the short run.
So the article's key takeaway seems to be, stay informed, resist the urge to panic, and consider that moments of crisis can sometimes present chances to capitalize for the future. It's a reminder that market downturns are a part of the economic cycle. And while they can be unsettling, they can also offer opportunities for those with a long-term view.
Absolutely. And maybe as you process all of this, here's something to really think about, kind of a final thought. Consider how significant market corrections have played out throughout history.
Looking back.
Yeah. What were the primary factors that triggered them? How long did those periods of uncertainty typically last? And crucially, what were the eventual outcomes for investors who remained disciplined and focused on the long term?
So learning from the past.
Exactly. Exploring those historical precedents can provide valuable context and potentially help you navigate the current situation with a more informed and less reactive mindset, rather than just focusing on the immediate, often noisy headlines.
A really insightful point to consider. Well, thanks for joining us on this deep dive.